Well, good afternoon and welcome to our HighRock weekly client webinar. If you want to skip over our standard introduction or any other part of this webcast, feel free to use the fast forward control on your screen. Otherwise, sit back and enjoy. Today we're going to talk about what we see happening in the global economy and financial markets and the world of wealth management and how all of this impacts our decisions on the best courses of action for our and your investment strategies. As you likely know, if you are a regular listener, we invest our money in the exact same models as our clients. We think that this is a very important highlight and defines our prudent and disciplined investing strategy. Our discretionary portfolio management not only ensures our legal fiduciary responsibility to our clients, but also enables us to make quick decisions and execute them immediately for all of us simultaneously. In tricky and volatile markets, this is crucial as we take advantage of the opportunities that avail themselves to us. I'm Scott Tomlinson, and joining us on the call today are my partner and colleague Paul Tepsich, the founder of HighRock. Our certified financial planning professional and wealth forecast specialist Bianca Tomlinson has taken a short leave to have her first child, a strapping young 10-pound boy named Mason, but she will be on call to us for her expert advice should we need it for you. We are recording this webinar so that those who can't join us live can tune in when it is more convenient. If you are a first-time listener, we would like a little more information about our private client services and our disciplined investing strategy. We do have a separate introductory webinar that will provide you with this, and all you need to do is visit our homepage and click on the Introduction to HighRock Private Client button. And while you're at it, you may be interested in our voluntary code of conduct as well, something that we think takes us above and beyond the regulatory requirement in many ways and highlights how we always put our clients' interests before our own. Well, let's start with a quick review of our themes for 2017. As you all know, we think that our strategy of taking a tactical approach to investing is even more important this year because of the even greater levels of uncertainty imposed on financial markets by an onslaught of evolving factors. As we approach the halfway point in the year, we see risks escalating, not diminishing. Well, inflation is a key determinant of central bank policy, and earlier in the year, expectations of increasing inflation pushed bond yields higher, but inflation has underperformed. While most central banks have been more cautious, the U.S. Federal Reserve has raised rates by 0.75% since last December, and it is expected that they may raise them a couple more times this year. We are concerned that this may be a policy mistake. Well, stock prices and valuations are at 14-year highs. Without more significant earnings growth, this leaves them vulnerable to correction. Risk in the stock market is therefore quite high. And while we wait on the Trump agenda to materialize in Brexit negotiations, protectionist agendas continue to raise concerns, as do tensions with North Korea, Russia, and the Middle East, and global cyber attacks, another one today. Terrorist threats all add up to the blend of political uncertainty that we are currently facing. Well, correlations between stocks and bonds are changing, and with that, some of the historical safety of traditional buy and hold balanced portfolios in the U.S. and in Canada. When we started our private client division over 2 years ago, we wanted to add a third dimension to the standard buy and hold balanced portfolio of equity and fixed income in an effort to add more value to client portfolios by reducing risk and further enhancing risk-adjusted returns. In essence, this, along with our strict adherence to our code of conduct, defines what makes HighRock different and better. So we are patient, waiting for opportunities to buy assets for our portfolios, and it may be a reason why newer clients might still have a little more cash equivalent assets on hand because building a solid portfolio takes time. No need to rush in and buy expensive assets if they are going to get cheaper. Well, each week we look at the benchmark indices performance to allow you to make comparisons to your own portfolio performance. You may notice that the post-Brexit market drop 1 year ago has impacted the one-year return rather significantly this week. Well, we take the allocation of the benchmark All-Country World Equity Index ETF and blend it with the Canadian Bond Index ETF to get a weighted return for comparison purposes. Now, you may note that while the one-year blended benchmark net of fees and post-Brexit, which featured some heavy volatility, has returned about 14.75%, the two-year annualized return has only returned about 4%. And that highlights the volatility over the last couple of years. Now, even the return over the last 3 years is well below the 5-year average. As you know, and I repeat each week, our focus is on reducing volatility in our portfolios in the short term in order to avoid big swings in return and capture more consistent long-term returns. As we look at a longer-term HIROC private client, the one-year total return performance after fees is about 10%. And with that Brexit factor definitely behind the benchmark at the moment, although that should change significantly over the next couple of weeks. And currently, with about 25% in a money market fund, this portfolio is significantly less exposed to expensive, risky assets like equities, which we believe are vulnerable to at least a 10% correction. But focusing on the longer term, for the 4.5-year performance in this portfolio remains well ahead of the benchmark. It shows how little of an impact the one-year period has actually had on the longer-term performance. And it's a sign that we have been successful in lowering that short-term volatility, which does, in fact, enhance the longer-term returns. Well, at HIROC, we focus on the difference between the absolute returns and the risk-adjusted returns, as I've said. The actual HIROC private client return per unit of risk taken on an apples-to-apples basis significantly outperforms the 60/40 comparative benchmark. Now, this is the key to steady, less volatile portfolio swings, which help to elevate returns over longer periods of time. Now, as we are coming up to the end of the second quarter, we will be updating this slide for our clients for their second quarter summary and performance reports, which will come out in a couple of weeks. And of course, we remind everyone listening that historical returns are no guarantee of future returns, but at HIROC, we do work very hard to provide our clients with the best possible risk-adjusted returns. We also believe that it is very important that we review your wealth forecast on a regular basis with you so that we can ensure that your long-term goals are still in line with your portfolio strategy and that our forecasts for your net worth into the future are up to date and heading in the right direction. Inflation is one of our key themes for 2017 as we try to assess the implications for central bank monetary policy and interest rates. And if economies are growing, so too should inflation be growing. Well, Canadian consumer prices for the 12 months ending in May were clocked at a slower 1.3% than it was in April at 1.5%. Now, shelter costs were lower, led by the cost of electricity, especially in Ontario. And as I suggested in my blog this morning, your own personal levels of inflation may differ from the average Canadians by what you consume and where you live to do your consuming. For us, these distinctions become important when we build your wealth forecasts, knowing what assumptions are best for each client as we project your cost of living into the future. For our purposes, we want to identify the longer-term trends that help us to make projections into the future as we update your wealth forecasts. Our monitoring is intended to provide you with any potential need for changing your portfolio strategy and making sure that we're doing everything we can to ensure that you are going to reach your goals and that the level of risk you are taking is reasonable in the context of those goals. Well, as for the Bank of Canada, who suggested that diversity of the Canadian economy was showing encouraging signs and that it was leading them to infer that they may have to raise short-term or raise interest rates, sooner than later. Well, all of their inflation indicators as of the most recent data, and that was announced last Friday, remain considerably below their targets, which likely means that any interest rate increases will not happen this year at all, unless somehow this changes quite dramatically. We don't think it will. But the longer-term trend does not seem to be indicating a pickup in inflation towards the Bank of Canada's 2% target anytime soon. Well, all central banks have a mandate to maintain price stability, but other than the UK, inflation remains below target for most advanced economies. The US Federal Reserve has raised rates by 0.25% twice so far this year, and they did it last December as well. But no immediate changes are expected for July and August central bank policy decisions at this point in time. But it is expected that the Fed may raise rates another 2 more times this year. However, that might just be a policy mistake. Paul, you wrote a very interesting blog on this today, and if you would, we'd love you to comment.
Yeah, it's kind of hard to see, but in the yellow line at the top, you can see what's called U.S. soft economic data, and the white line is U.S. hard economic data. And just to define, soft data are economic statistics that come out usually on a monthly basis that are more geared towards surveys of businesses and consumers or indices, things like that. They're a little more non-empirical, whereas hard economic data are more of the empirical numbers that come out, like GDP and actual numbers. And as you can see, obviously, we've had, since the start of the year, it's been trending down. It's been, we had a pretty big move down lower in February, and then a really big move down at the end of April into May on the hard data, and then just over the past month alone. And what's kind of interesting is the soft data has started to give up the ghost as well. And I think, and you could probably read the blog for more detail, but the soft, why it's important to see the soft data starting to track and come off like the hard data is that as consumers and businesses become less confident for whatever reason, whether it's a lack of follow-through on the new Trump administration's policies or ability to get things done as quickly as they had hoped, that confidence, waning confidence in consumers and businesses is not good for the economy. So just another reason why we are more cautious here with our capital. Is that good?
Thanks, Paul. That's great. And as we said, U.S. core consumer inflation is still well below target. We'll get another reading on that in the next few days, but something important to look at is the inflation data just isn't heading in the right direction for the Fed. So a difficult decision for them to make, certainly. And as we've been monitoring, the forecast for U.S. GDP continue to slip lower as we proceed through as we proceeded through the second quarter. Of course, most of the data for the last month of the second quarter will be out next month, so we'll continue to monitor this very closely. U.S. and Canadian 10-year bonds are a little changed from last Tuesday, but the recent trend since December has been actually towards lower yields. And remember that bond markets do tend to lead all other financial markets. So if yields are moving lower, that should start to perhaps impact the equity markets and other markets that will follow. The 2-year to 30-year U.S. bond differential has narrowed by another 4 basis points over the course of the week to 1.36 or 1.36%. And we know that that's important because, as I've suggested many times on this call, when the yield curve gets to a flat position, and we usually see a recession following, and the Fed tightening and low long-term bond yields, if they remain that way, will soon flatten the yield curve further. We do definitely need to watch this closely. And today, the International Monetary Fund lowered its forecast for the U.S. economy, saying it could no longer assume that the Trump administration will be able to deliver pledged tax cuts and higher infrastructure spending. The IMF, in its annual review of the American economy, questioned the White House's plan to accelerate output and said it was skeptical the administration would be able to rev up the world's largest growth engine to a sustained 3% annual rate, as had been suggested. Instead, it dropped its growth forecast to 2.1% for 2017 and 2018 from 2.3% and 2.5% respectively. And the yield curve in Canada is also collapsing. Bond traders are showing the Bank of Canada what they think of the bank's latest suggestions on interest rate increases. And you can see that that change is down another 5 basis points from last week and approaching its lows that we saw back in the third quarter of last year. We are also paying close attention to the global debt situation and borrowers' ability to service that debt. As we show each week, global debt levels are growing at an approximate rate of 5% per year, while the global economy is only expected to grow at a rate of about 3% per year. In its annual report released last week, the Bank for International Settlements highlighted Canada as being especially vulnerable to banking sector stress because of its property boom. So we are paying close attention to that situation as it evolves here too. As I've mentioned every week, I guess, for the last couple of years, we think stocks are and continue to be expensive. The 12-month forward-looking price-to-earnings ratio is at 17.6 times, which includes expectations of about a 10% earnings growth rate for 2017. The 10-year average is at 14 times. Now, just to get back to that average, earnings would have to grow by an additional 20% in the next 12 months above the already expected 10% growth. We don't think that's quite likely. So we are very uncomfortable with the current valuations. If the U.S. economy can't grow more than 2%, it is hard to see earnings achieving even the 10% that is currently anticipated. Stock prices have been outperforming economic growth by a fair margin for quite some time. And over the last 2 years, the S&P 500 in white has been the best performer, closely followed by the German DAX index, which is in gold. The TSX is in purple and the Japanese Nikkei index in green. Now, our benchmark all world country index is made up of about 50% U.S. equities, about 7 or 8% of German equities, another 7% or so of Japanese equities, and only about 3% are Canadian equities. And another of our metrics of value, enterprise value to EBITDA, continues to show stocks to be as expensive as they were at the time of the dot-com bubble. High equity prices equate to high risk, so we continue to remain very patient and erring on the side of being conservative at this juncture. Okay, let's check out what's going on the geopolitical front this week. The Trump administration has been trying to move its agenda forward, but Senate leaders today decided to put off a vote on Republicans' health care bill until after the July 4th recess. And according to a person familiar with the plans, amid growing opposition from Republican members to the plan drafted in secret by Majority Leader Mitch McConnell, the decision to delay the vote planned for this week follows announcements by at least 5 Republicans that they'll vote to block Senate debate on the bill. And McConnell needs support from at least 50 of the 52 Republicans to move forward with the measure. The latest budget push by House Republican leaders has faltered, leaving quarreling Republicans almost 3 months behind on their budget work as they head into next week's recess. Tuesday's deadlock is the result of a battle between conservatives demanding greater spending cuts and the committee chairman who would have to carry them out. As a result, a planned vote this week on the Republicans' latest fiscal blueprint was canceled before it was officially scheduled. Now, progress on the tax reform appears to be stalling as well, one of the reasons the IMF lowered its economic growth forecast. Well, in the month after U.S. Trade Representative Robert Lighthizer mid-May notification to Congress that the NAFTA pact would be renegotiated, his agency got more than 12,000 public comments on the matter, crashing the server and forcing him to extend the comment period. While unraveling European law and enshrining new UK legislation after Britain leaves the European Union is the most complex legal challenge the country has confronted, one of the top judges has cautioned. Brexit is probably amongst the biggest peacetime issues that the UK has ever faced, without doubt. The most complex in legal terms, Lord Chief Justice John Thomas said in a speech to lawyers yesterday in London. And more than 80 companies in Russia and Ukraine were initially affected by the Petya virus that disabled computers today, and told users to pay $300 in cryptocurrency to unlock them. Telecommunications operators and retailers are also affected, and the virus is spreading in a similar way to the WannaCry attack that we experienced in May. Well, so here at High Rock, we want to continue to get portfolio growth, but we are also not comfortable taking equity market risk with the current situation concerning stock prices. The U.S. economic cycle is in its late stages, and there are signs that make us uncomfortable with having too much risk in our models and portfolios. We and our clients have worked too hard for our money, and we want to make sure that we invest it prudently. We are stewards of wealth. We are not gamblers. Paul, any comments on what you've been up to this week?
No portfolio changes at all, Scott. I've been doing a bit of research, but I haven't executed any portfolio adjustments or new positions into the portfolios at this stage. Looking at a couple things, put my pen down on one late last week that I think we will just wait on. But no other changes. So nothing really to add from there.
Okay. Well, thanks for that. And obviously, as all our clients know, we would much rather err on the side of caution, especially at this particular point in time. Well, I want to thank everybody for taking time out of their busy schedules to tune in. If you have any questions or concerns or any comments and feedback, please definitely feel free to email them to us. We will be back with our next update, not next Tuesday, but the following Tuesday. Next Monday, Tuesday is the combination Canada Day and U.S. Independence Day holidays. So we're going to skip next week. But we will be back on the 11th. So until then, this is Scott Tomlinson, and on behalf of my colleagues, Paul and Bianca, we want to wish you all a great rest of the week. Happy Canada Day to our Canadian listeners and friends, and certainly happy 4th of July to all our U.S. listeners and friends.